2 p.m. here in New York, 7 p.m. in London, live from Bloomberg World Headquarters. This is Bloomberg Markets to Close. I'm Romaine Bostick.
And I'm Taylor Riggs. Caroline Hyde is off today.
U.S. stocks turning lower, struggling. Small caps heading for their biggest drop in 2 months, with the Russell 2000 tumbling 2%, the S&P 500 edging off record highs, all as hopes fade over those $2,000 stimulus checks. And blocked by McConnell, the Senate Majority Leader squashing an effort to increase those direct relief payments after the measure passed the House, despite it winning over an increasing amount of support from his own caucus. And return to flight. How about this? After 2 deadly crashes that forced an unprecedented 2-year hiatus, Boeing's 737 MAX jet back in the sky in the U.S., American Airlines flying from Miami to New York. We're going to talk about that and so much more today on this beautiful Tuesday afternoon here in New York. But let's get a check here on the markets. Coming off those record highs that we saw yesterday, Taylor, not quite getting it there today. We did see the S&P 500 open higher on the day. That was primarily led by some gains that we saw in the healthcare space, particularly with a lot of those medical device companies. But a lot of those big cap tech names, some of those discretionary names, really weren't participating much in the rally today. Apple, which at one point was trading at a record high, also pulling back slightly here on the day. So call it flat. We did see a little bit of enthusiasm over in Asia, the MSCI Asia Pacific Index rallying today. A lot of that because of a rebound that we're seeing in Alibaba, JD.com, Pinduoduo, and a lot of those Chinese tech names that have been sold off because of concerns about regulatory issues. Dollar weakness, we're going to talk about that a lot today. And one of the reasons why you're seeing that dollar weakness is that line you see at the bottom of your screen. Inflation expectations, once again, for a second day, scraping near that 2% mark. We're going to talk a lot about what the Treasury market is telling us, what inflation expectations are telling us, and what the dollar could be leading us to.
Well, if you're trying to get inflation expectations to creep to 2%, you're looking at a 10-year yield that's also trying to creep to 1%. We're only up about a basis point, and I kind of sound like a broken record. But again, we're at 93 basis points. The long-term trend since the summer has been upwards, but, well, we are nowhere near where we started the year. I want to talk about another stock that is nowhere near where it started the year. Romaine, Apple. It's the world's biggest company. It also managed to increase its market cap by $1 trillion. And then Microsoft there in blue, starting the year at 1.3 trillion, ending the year at about 2.3 trillion, 88% return. What do you make of that?
That's been a pretty good year for Apple. I mean, it's the second year in a row. I think they've topped 80% price return there. So definitely a bet, and for some people, a bet that they missed out on. Let's talk a little bit more about the markets, about the economy, and everything in between. David Kotok, we love him. He's the chairman and CIO over at Cumberland Advisors, joining us today from Sarasota, Florida. David, great to have you back on the program. Let's start out with the general outlook here going into 2021. On the whole, right now, things look relatively positive, don't they?
Well, they do. First, let me just say Happy New Year, Romaine, to you and to Taylor. It's nice to be with you. Thank you for having me on before the end of this year, which we're happy to say goodbye to, and I'm sure you've heard that now 100 times. Yes, the outlook is for recovery. That's underway. There are questions. There are stumbling points. When you think about this year, after March, 33 million people applied for an unemployment benefit. So we really had a shock. And as you just reported, we're going to have 400,000 people dead in the United States. That is another shock. And when the GDP numbers for this year are done, we'll have a down year of 4 or 5%, another shock. So substantial shock from which this volatile, sort of crazy kind of recovery is happening.
Yeah. And
it probably continues.
Yeah. So, David, when you look at obviously a lot of pain out there in the real economy, I guess the economy that you and I see on the ground, we did not necessarily see investors get as spooked. Obviously, there was that big sell-off in March, but by the time we got to May and June, so many people were willing to come back into the equity markets and into other risk assets. And so far, that's been a bet that's paid off pretty handsomely. What do you think explains the disconnect between the two?
Well, if you break down the population of the United States into 3 cohorts, the very affluent or the affluent, the middle, and the lower income or working lower income folks. They're the ones who are the upper levels, the wealthy, the affluent, the professional class that was worked by Zoom or Teams, they're almost whole. They've been able to continue their incomes. I'm an example. We remote working with almost 46 people the entire time. So we really sliced the US economy into different pieces. The pieces that are hurt badly. The pieces that are intact, and Cumberland's an example of them, are growing, continuing, working. And the middle is stressed. And that's how we start 2021. The whole key is to have the people hurt the most recover enough so they can begin to flourish again.
David, over the years, you and I have talked a lot about treasuries and the role of bonds in a portfolio. Does full faith in credit at 93 basis points make sense to you as a buyer?
Taylor, I was waiting for you. The answer is no.
Am I that predictable?
Well, you're wonderful, and the fact is, you're a runner. You know what it's like to have to go a distance, and I wouldn't put my money at 93 basis points in a 10-year treasury. I cannot do it for a client. Now, there are clients who have no choice. They have to own governments. But if you have other choices, if you can make the allocation decision differently, then I would underweight long treasuries. There are much better places in bonds for opportunities. The municipal bond market is one of the sectors. I know you understand and work with that sector. And there's the stock market. And there are other things too, if you can stray away from liquidity into less liquid places.
Are one of those less liquid places high yield, or have those spreads contracted too much?
Oh my gosh, the spreads, look at what happened to them. I mean, some spreads blew out 1,000 basis points in March and April. They've all come back. If you looked at the spreads today and you looked at the spreads 1 year ago, you would say nothing happened. And that's not true. We've got a shock. So I worry about high yield. I think you really got to take a deep dive in credit. You want to get paid. Traditionally, you're not getting paid by traditional standards for the junk bond risk that you would be taking at these spreads. There are a lot of people doing it. We're not among them.
When we talk about inflation expectations, David, and the idea that we could get to a stage where we see some of those price gains eroded by inflation, is that a shorter term worry for you, meaning in the next year or so, or is that not something that you think investors should be too worried about?
Well, no, I would worry about inflation. I think an investor should always worry about inflation every single day. Set that aside and look at market-based pricing right now. And if you take the TIPS adjusted treasury yield and inflation forecast at 5 years, you get roughly 2%. I think it's 1.9 right now, something like that. If you take it for 10 years, you get 5 basis points more, which is an unusual relationship for me, because when you do a forward rate analysis of live market-based prices, you would say, gee, the market is projecting a 2% inflation rate for 5 years, and for the next 5 years, no change. How can that be? How can the market be pricing what I think is a pricing anomaly? Shouldn't there be a risk premium for the second 5 years, which we know so little about? We have enough trouble with the first 5 years. So I don't know how to wrestle down this inflation question. It's a very difficult one. I might add, if I have a quick few seconds, we have every major central bank in the G7 targeting 2% inflation. They measure it different ways, but 2% inflation. Not one of them's been able to hit it for the last 10 years. So you have to say to yourself, what's it going to take for us to get inflation above 2% on a sustained averaging basis, which is the Fed's target number? It might take 2 or 3 or 4 years to get there. I think that's distinctly possible.
Well, those are questions that we're going to let you grapple with and then hopefully come back in a few months and give us some more answers to. Thank you as always there, David Kotok, Chairman and CIO of Cumberland Advisors. And coming up, taking flight after a 2-year hiatus, the Boeing 737 MAX resumes flying, but will passengers feel safe? Plus, that stimulus standoff, how $2,000 has President Trump fighting against his own party and siding with the Democrats. We have the latest. And testing Fubo TV's rally, how the new year may fuel new declines for the sports first streaming platform. All that and much more coming up. This is Bloomberg. There's some sad news about the Boeing 737 crash about 20 months ago, and then, of course, the good news of returning back to business today. The bad news, though, certainly reflected in the share price. When you take a look at Boeing there in purple, off about 45%. American Airlines, since the grounding of these airlines, also off about 50%. They're underperforming not only the airline index, but the S&P 500 over that period of time. For more on this, I want to bring in Justin Bachman, who covers airlines, travel, and commercial space for Bloomberg. And Justin, I think for today with Boeing, no news is good news, right?
That's exactly right. Today, when you have the MAX returning to the United States for commercial service, what American and Boeing want to see is absolutely nothing unusual about the flight. They don't even want to see a slight delay for anything. And that's what they got on the first flight today from Miami to New York.
And as far as just the general confidence, I guess, in the potential buyers of this, we know this is obviously the plane with the biggest backlog for Boeing here. Are we sort of, are you at a stage now where you can start to model in some of these orders as actual revenue down the road?
Yes, they're at the point where Boeing is able to resume deliveries, and you won't see a whole lot this year because it's so close to the end of the year. But for 21, the MAX is really going to gear up, and Boeing has had some pretty good results in the last few weeks as far as customer orders from Ryanair, which is taking 75 more jets, and Alaska, which added to their MAX order. So you put in the combination of the pricing and the airline's desire to move on to a more fuel-efficient jet than what they were flying before. And you're going to see some major deliveries next year.
I want to talk about the deliveries and the impact on the balance sheet. I remember when the grounding first started, a lot of analysts were defending Boeing. This is a company that at the time was pulling in $12 billion in free cash flow annually. There had been some concerns lately, though, as free cash flow turns negative, trying to shore up cash on the balance sheet to make sure that they were okay to pay off some of the debts and loans. How does this now impact the financials of Boeing?
Well, the big issue and the big problem for Boeing is going to be this pandemic, as it is for Airbus and every airline on the planet. And what really, they need to see happen is that people have confidence to travel again, and you start to get back to more normal patterns of behavior. And until then, everything is really kind of up in the air in terms of what kind of fleet strategy will airlines pursue? Do they want more airplanes? And will Boeing be able to actually deliver a lot of what they've got on the books? And I think what everybody's looking for next year is the pace of vaccinations and the pace at which the consumer says, I can return to what I used to do. And we haven't seen that yet.
It's been a challenging couple of years here for Boeing and really the airline industry as a whole. But of course, good news here, seeing that 737 MAX just about an hour ago making its landing here in New York at LaGuardia Airport. Justin Bachman, we'll catch up with you soon. All right, coming up here next on this program, we're going to talk about that stimulus. Well, Mitch McConnell, Senate Majority Leader, sidestepping the debate right now on that $2,000 stimulus check, despite increasing support from his own party. We're going to head down to Washington next. This is Bloomberg.
We have quite the news coming from Washington, D.C. It was interesting. I want to pull up a tweet from Republican Josh Hawley, who said that the Senate had enough votes to pass legislation boosting those stimulus checks to $2,000 from $600. But then, well, not quite. Mitch McConnell came out and vetoed that vote. For the latest confusion, to help clarify it all for me, let's bring in our Bloomberg chief Washington correspondent, Kevin Cirilli. Kevin, remind us what happened in that noon hour with that big veto.
All right. Three big things. First and foremost, Senate Majority Leader Mitch McConnell largely expected. He said that there is going to be a vote on the Defense Authorization Act sometime within the next 24 hours. Remember, President Trump had vetoed this. Republicans for weeks have been forecasting that they have the votes to override this crucial national security vote for the United States. And in fact, Leader McConnell saying that vote will be held in the next day. As it relates to the stimulus checks and the 2,000 stimulus checks, the Cash Act has been voted upon in the House of Representatives, in the Democratic-controlled House. It did garner Republican support and cleared the House with more than two-thirds of votes for it because of a procedural hurdle known as unanimous consent and a fast track, which would require two-thirds of a vote. Then it got to the Senate. Leader McConnell blocking Senate Minority Leader Chuck Schumer's effort to have an immediate vote on the 2,000 stimulus check. What is unknown is whether or not this is a done deal and that there will not be any vote on this in the next week or so. The politics of this, as you've rightly pointed out, Taylor, are fascinating. Senator Josh Hawley, largely thought of being a 2024 presidential contender. He has introduced legislation, bipartisan legislation with the likes of Senator Bernie Sanders, for example, supporting $2,000 stimulus checks. Yeah. Then you've got Senators David Perdue and Kelly Loeffler up the Republicans for re-election in the Georgia runoff, also coming out in favor of the $2,000 stimulus checks, a populist streak of republicanism that President Trump is now behind.
Yeah, and we also saw Hawley tweet a little bit earlier saying that the Republicans actually had the vote to do this. So it'll be interesting to see whether McConnell continues to push back. I am curious. A lot of people, Kevin, have their eyes on January 6th. Of course, that's the day the electoral votes are supposed to be tallied, or I guess certified, if you will, by Congress. Any sense here that that could go awry?
Well, there's virtually no chance that this will be overturned. What's important to note is the positions that Republicans take on that date. I'm thinking, for example, of Vice President Mike Pence, as well as some other Republicans who are looking at their long-term political futures, and the comments that they make could be an issue in a potential primary season ahead of the 2024 elections. But it's the last week of 2020. It's been a long year for all of us, right? We don't need to be thinking of the 2024 presidential cycle. But you know me, Romaine. I love presidential politics. I live for it. I live for it. I'm ready to get back on the campaign trail.
All right, put up the countdown clock. 4 years ago. All right, Kevin Cirilli, our chief Washington correspondent. Get some rest. We'll catch up with you shortly. Right here, right now, let's get a quick check on the Business Flash headlines. Global lockdowns have proven to be a big boost for the world's largest cigar producer, much, of course, to Taylor's joy. The Dominican Republic is on track to export a record $1 billion worth of tobacco products this year. That would be a 6% increase from last year. The president of a trade association says that cigar smokers are spending more time and more money on their habit since the pandemic hit. And shares of Fubo TV, another favorite of Taylor's, are down again today. This after falling 38% the previous 3 sessions. Shares of the Sports First streaming platform had more than quadrupled after a $197 million additional offering back in October. But analysts, they've cautioned investors on that run-up, and restrictions on insider selling, well, they start to expire tomorrow. And it's a first for the National Football League. Carolina Panthers tackle Russell Okung will be the first pro football player to collect a portion of his paycheck in Bitcoin. Okung is going to get about half of his $13 million salary in the cryptocurrencies. He's doing this through Zap's Strike product. So we should point out, Taylor, that the NFL isn't technically paying him in Bitcoin. They're still paying him in the traditional fiat currency. And then Zap has a Strike product where effectively it converts it immediately into crypto. He's been advocating this for a while. And anyone who doesn't know Okung, he's been banging this drum, not only on Bitcoin, but really on the idea of financial independence for football players for quite some time now.
You know, it was interesting. Yesterday, we were speaking to a lot of guests, and we asked about the use case of Bitcoin and if it looks in the future like the same use case that we're using today. And I think the guest said that it's a tough question. And this sort of shows, I think, the ever-evolving nature of Bitcoin.
Yeah.
My question, Romaine, you going to get your bonus in Bitcoin?
Should I get paid?
Convert 50% to Bitcoin.
I don't know. Maybe I'll take it in Dominican cigars. That's up 6%, right?
Fubo
Done
TV.
well. All right, let's get a quick check of where we stand in the broader markets here. Of course, Taylor, yesterday we had the S&P 500 at that record high, the Dow, the NASDAQ as well. Today, well, you could pretty much call it flat. And we should point out too, Taylor, I mean, volumes over the last couple of days have been well below average, as you would generally expect here after the Christmas holidays. Again, this is a shortened week, so not sure how much you can make of some of these price gains, though the Russell 2000, an interesting move here, Taylor.
And those are the trends that continue. A little bit of a sell-off in the Russell 2000, the small cap stocks, those that really benefit from stimulus, while FANG, big tech, the only sector that, well, it was in the green, and that continues to be the safe haven.
And some of those Chinese internet tech stocks rebounding a little bit today, clawing back some of those losses that they had over the past couple sessions. We'll be back in a moment. From New York, this is Bloomberg.
This is Bloomberg Markets The Close. I'm Taylor Riggs.
And I'm Romaine Bostick. A little after 2:30 here in New York. Let's get you caught up here on the moves that we've been seeing in the oil markets. NYMEX crude futures right now settling in at an even $48 a barrel. The 47.98, of course, on your screen. That's the tick into the new session here. Most of the gains we saw today largely related to some of that dollar weakness. You're seeing natural gas futures rebound. Of course, remember that we had that big drop over the last couple of days on concerns that weather wouldn't be cold enough. Some of those bets being dialed back a little bit here on the day. Gold futures also getting the bid. Of course, that's also tied to some of the moves that we've been seeing in the dollar and in real rates here. And then down at the bottom, copper. Copper showing a little bit of weakness here on the day, but still setting up here for one of its best years in quite some time, Taylor.
I want to go to another commodity, and that's the price of your home, which just appreciated 8% in the past year. We got our 20-city home price index rising about 7.95% year over year. It was the biggest gain since 2014. The biggest gainers by city, Romaine, Phoenix and Seattle. This highlights the migration trends that we've been talking about into Arizona, into Washington. You can't leave out Texas either. And a little bit of this flight out of some big cities like, well, maybe San Francisco and New York.
Yeah, well, let's talk a little bit more about that and get a sort of broader look at the economic landscape as well. We're going to bring in John Tyalor, of course, professor of economics at Stanford University, and really a long resume that's just a little bit too long to go into every sort of data point here. But John, let's start off with the migration patterns here.
The audio has gotten quite weak, but I can roughly hear what you say. There's some of the big firms here. Hewlett Packard is one is going to move their headquarters. Oracle. Elon Musk is talking about moving his residence, and so there's a lot going on, and I think it's culminated because of Zoom and the ability to work away from the office, which we're all seeing the consequences of. But it's an issue I think that California needs to address and soon.
How much of a regulatory burden is also helping to facilitate these migration patterns?
It's part of it. There are some studies that show that the regulatory burden in California is very high. Some show it's second in the country in terms of all the things, occupational licensing, wages, et cetera, like that. And they tend to be under the radar screen. People don't notice it that much. It's hard to measure. It's hard to get your hands around, but there's quite a big of difference, and I think that's one of the reasons people are moving. I've been noticing it for a while. Sometimes I give talks for Stanford, for the Hoover Institution where I'm located, and they used to be all in California, but now I find myself going to Texas, going to Florida, and that's because people have moved there, and they're continuing to do so. And I think part of the reason is, as you say, the regulatory differences are quite a lot.
It's interesting, though, that those regulatory differences, to a large extent, sort of is what led to the growth in population, the growth in businesses in California many decades ago, more than a century ago, really. Eventually, regulation had to catch up with that population boom, with that increase in businesses. Do you worry that we're going to get into a situation where the Texases and Floridas of the world will have to respond with their regulatory system in some way?
Well, I would prefer if the response is to make both Texas and California more business friendly, because we need to grow more in the United States. We need to have a system that's conducive to growth. And you're quite right, Romaine, the people who came to California goes back to the gold rush. It was tremendous opportunities, and people came here. A lot of them didn't find gold, but they found a wonderful place to do business. And some of the places I mentioned, I'm speaking here from Silicon Valley, where Stanford is. And a lot of them were started here because of the agglomeration, the ability to make progress and to do work together. And it's important to preserve that, I think, and to make it more general in the country.
We love that your blog is titled Economics 1, which is the class of course that you teach there at Stanford University. Broadening out, we started this segment looking at home prices, the biggest gain that we've seen since 2014. Does any of this sound unsustainable? I'm hesitant to use the word bubble, but it does liken back to some of the big price gains that we have seen in decades past.
So I think some of it is depending on the regulations. The land use regulations in California are quite a bit. So that bids up prices in certain areas and makes the prices lower in other areas. I think if we could have a better land use policy, that would be better. Texas has very little or sensible, and so that's why you see some of the firms opening there. So it's a bubble only in the sense you can do something about it, and you can make some changes that make things better. So I hope some of this migration, this exodus, this stampede is waking people up. Say we've got to do something. This is a business decision, and we want jobs. We want income growth in California to continue.
John, I want to get your broader thoughts here on economic stimulus and the debate here over how you sort of deal with an economic crisis, economic shortfalls, without at the same time stoking inflation or stoking sort of a negative response in the economy. What's your general view here as to what the fiscal approach should be?
I think the main thing is to show how we're getting back on track eventually. Right now, there's the 900 billion, of course, is passed and ready to go. There's a question of adding more to that. What I would like to see, whether or not that goes, and the evidence says that's probably not the most important use of the money, and we're probably going to get more, is to have a way to undo it, to go back to normal. And that's also true of monetary policy. Monetary policy actions in earlier in the year, in March and April, were needed and they were appropriate. But now even monetary policy needs to think about a return to normal. And we have the vaccines coming on board. That's a promising thing. And so economic policy needs to be aware of these changes, both monetary and fiscal.
When is it appropriate for us to begin re-examining debt as a percent of GDP and fiscal deficits with all the helicopter money?
I think it's a problem that we're facing now. It's very important to do what's necessary in this environment, but somehow you also need to get back to normal. And I think we're mixing the two together. I've written about this in the crisis, the global financial crisis, 2007, 8, and 9. Some of those actions were not very beneficial. We had a relatively weak recovery. I want to have a strong recovery. And so that's why it's necessary to not just deficit, but recognize that eventually that has to slow down. And so does money growth.
All right, John, always great to have your thoughts. John Tyalor, of course, a professor over at Stanford University, of course, one of the most influential economists out there today, and of course, one of his main contributions, the Taylor Rule, which of course has nothing to do with Taylor rigs. All right, coming up here next on this program, we're going to talk about Intel. The shares there are spiking today. Some interest here by activist investor Dan Loeb. We're going to talk about some of the strategic changes his hedge fund, Third Point, is pushing for. That's our stock of the hour. Coming up next, this is Bloomberg. All right, although the COVID-19 vaccine is set to become more accessible as companies like AstraZeneca get approval for distribution, Johns Hopkins University senior scholar Hamesh Adalja believes we'll still see a spike of cases as people fail to avoid holiday gatherings. He spoke a little bit earlier with Bloomberg's Guy Johnson about currently overwhelmed hospitals and a record number of cases in the U.S.
I definitely think it can only get easier as we get more candidates on the market, especially if they don't have really strenuous cold chain requirements the way the Pfizer vaccine does. And the AstraZeneca vaccine, I think, is going to be a win for the world, because if you think about trying to keep the cold chain intact in parts of the developing world where there is not very stable electricity, let alone access to deep freeze storage, I do think that this may be the vaccine for the world when it does get its approval.
One of the big challenges at the moment appears to be staffing. And it appears to be, and I keep bringing this up, there appears to be a zero-sum game that's working. On one hand, we have the need for staff to deal with the ongoing spike in cases that we're seeing around the world. On the other hand, we need staff to vaccinate people. Is it a zero-sum game? And in the moment, are we finding ourselves in a situation where we simply don't have the people to deliver the vaccines that have already been delivered?
Staffing in healthcare centers has almost been something that's kind of defies what happens in other markets, where there is an increased demand for labor and then more people go join that, because there's so many barriers to becoming a healthcare provider. You can't just hire people. And, it's unfortunate because we've had a long lead time. We knew that there was going to be this surge of cases in the winter, yet many hospitals didn't really have the resources to increase their staffing, increase their capacity. And it is true, if your hospital is busy dealing with so many COVID patients and you've got staff out sick because they're getting COVID in the community, you're going to have a much harder time having enough people to vaccinate. We are seeing vaccinations in the United States at least ramp up now. It was something that kind of trickled out in the first days of the vaccination. I waited a couple of days before I was able to get my vaccine, but now it seems to be moving at a much more rapid pace. But yes, I do think as we move into the community, away from hospitals and nursing homes, we're going to need a lot of community vaccinators to be able to get enough shots in the arms of people to hit herd immunity. So I do think this is something we have to really think about, a sustainable approach to vaccination.
In terms of what you're expecting over the next few weeks, are we going to see a spike in cases as a result of the holidays? How big a spike do you think we are likely to see? I think I was on one of the front pages of the newspapers this morning that we have seen post-pandemic records in terms of air travel over the last few days.
It's inevitable that we're going to see a spike in cases. You have to remember that this virus thrives on social interaction, and many people traveled from one state to another and went to private gatherings where likely they let their guard down, didn't wear face coverings as meticulously as they should have. So we're going to see some level of transmission. Hopefully it's not something that really puts us kind of on a surge on top of a surge on top of a surge, to borrow Dr. Fauci's phrase, but it's likely that we will see some level of increase at a time when we already have record numbers of cases and record numbers of hospitalizations. Hopefully people took some level of precaution so that we won't see as the worst case scenario. I think that happened in some parts of the country during Thanksgiving. We did see increases all over as a country as a whole in the United States, but some states we did not. And maybe, hopefully that will happen again in Christmas. But I do think we have to be prepared for more acceleration of cases as we get into the next few weeks.
Johns Hopkins University senior scholar Amisha Dalja speaking earlier with her own Guy Johnson. And your favorite disclosure, Johns Hopkins Bloomberg School of Public Health is supported by Michael R. Bloomberg, the founder of Bloomberg LP, which is the parent company of this network. Now let's get a quick check on some of the latest business flash headlines and other stories that we're following in. While Romaine DNA testing company 23andMe has raised more than $80 million in equity in a financing round. The round was led by Sequoia Capital and New View Capital. Consumer genetics firms like 23andMe have turned recreational DNA testing into a widespread phenomenon. More than 12 million customers have spit into a tube, that's gross, to learn about their ancestry and their health backgrounds.
Science, Taylor.
Traders have boosted their bets against the U.S. dollar to the highest in almost a decade. Net short positions in futures linked to the ICE U.S. dollar index have risen by the most since March of 2011. U.S. deficits and Federal Reserve policy seen as weighing on the greenback. That conversation coming up in just less than an hour as well. And Apple shares have rallied to a record. That continues a year-end surge that has locked in its lead over Amazon's 2020 best-performing large tech stock. Apple is up more than 16% this month, 88% for the year, all thanks to demand for that new iPhone. There's also optimism about Apple's self-driving car project. Romaine?
All right, time now for our stock of the hour. We're talking about Intel. I mean, come on. Intel, the worst performing stock this year in the Philadelphia Semiconductor Index. Today, it's the best performing stock of that index, almost up 8%. Abigail Doolittle is here to tell us what's going on. Abigail.
Well, Romaine, you have these headlines with Dan Loeb and Third Point basically rattling the saber, saying that something needs to be done here. They are a significantly large shareholder of Intel, basically saying that this company has not done what they should with their assets. They frittered away their top positioning in the chip market, and they've also overcompensated executives. So they haven't gotten too specific, but basically making the case that some sort of sum of the parts situation here could be more attractive. As for the stock itself, in terms of why they might want this to happen, you were talking about that underperformance. Take a look at the stocks outperforming on the year, up about 50%. Intel down on the year. So really pretty stunning that you could see that kind of underperformance given the hot nature, the space of chips. Relative to the fundamentals, well, maybe Dan Loeb does have a point, and Third Point has a point, because they have put up revenue declines for 4 quarters in a row, really underperforming. AMD, of course, hot on their trail, pressuring them in a big way. That's showing up in the numbers. So I think it's a combination of the numbers just not working in the right way, and you see that their big portion there of data center platform need to be able to do more with that and expand to some degree, Taylor. When you combine that with the stock down in such a big up year, it causes activist investors, again, to get active.
I want to speak about active. Some of the largest holders that I see here are some of the big buy-side guys. Where does Dan Loeb and Third Point fit in terms of the holdings of Intel?
Well, it's an interesting question, Taylor, for sure, because his holding is thought to be somewhere around $1 billion, which undoubtedly is a large amount of money. But the largest shareholders, including Vanguard, BlackRock, and State Street, as we're seeing here, much, much more significant in terms of the overall holding. So, you know, you could make the case that Dan Loeb and Third Point relatively small, but he has a big name. He's a well-known activist. So when he makes this kind of an announcement, sends a letter, shareholder letter to the board, investors clearly take note with, again, as Romaine was saying, as you were saying, Romaine, the best day since May.
Yeah, best mover today right now in the second best mover, I should say, out there right now in the S&P 500 and best in the Philadelphia Semiconductor Index. Abigail Doolittle, our stock of the hour, Intel, 8%. Coming up, a Wall Street reality check. We'll talk about those bonuses. The biggest U.S. lenders tempering expectations for employee bonuses despite all that soaring revenue. That's coming up next. This is Bloomberg. All right, time now for our top calls to look at some of the movers on the back of analyst recommendations. Snap first up. The price target being raised to a street high $70 over at Goldman. The analysts expecting revenue growth to accelerate amid recent innovations, product partnerships, and a favorable backdrop for online advertising. Shares right now up 5% on the day, tripling on the year. Next up, Tesla, stock of the year, obviously. That price target being boosted to $380 from $300 over at Cowen. A little behind the times, but the analysts expecting a strong close to the fourth quarter of 2020 shipments, with deliveries picking up steam in December in the U.S. and in Europe. Shares of Tesla basically flat on the day. And finally, let's take a look at Wells Fargo. The price target going to $35 from $32 over at Raymond James. Not much, but the analysts noting Wells Fargo's progress on improving its ESG standing, though he does believe it will take some time for the bank to reap the full rewards of that. Wells Fargo shares call it flat on the day. And Taylor, those are some of our top calls.
And we want to stick with some of the banks and that theme, Romaine, because Wall Street banks are actually tempering back some of the expectations for bonuses this year, despite a huge trading bonanza. For more, I want to bring in our finance reporter, Linan Nguyen. Interesting, though, that given the good performance, bonuses are being tempered. As you take a look at all the banks out there, who's the best? Who's giving out the worst?
Hi, Taylor. Yeah, well, it looks like Goldman Sachs and JP Morgan are going to be the most generous in terms of their bonus pools, possibly raising bonuses by as much as 20% from 2019 levels. But still, in this very unusual pandemic year, we are seeing some pessimism across the street, some signs that, you know, performance is not necessarily going to translate to those big bonuses that you've seen in years past. And of course, at Bank of America and Citigroup, there is potentially a flat bonus pool at B of A and flat for the Citigroup equities traders as well. So there are some, kind of disgruntled noises across the street right now.
Well, as you would expect, I mean, the whole sort of social compact on Wall Street is that performance and pay are pretty inextricably linked there. What's the general rationale for not providing, I guess, a commensurate bonus pay based on the performance?
Well, Romaine, it's a little bit of a, what goes around comes around. Obviously, traders have done really well this year, but they're going to have to carry some weight for the consumer divisions of the banks, which obviously are struggling in this pandemic environment. And at the same time, trading divisions have not been doing particularly well over the past few years. And during those years, the consumer divisions were the ones that were kind of propping up the bank's results. So if you want to talk about a kind of diversified businesses, the banks have some divisions that do better in situations like this, during, crazy volatile markets, and it has divisions that do better under different economic circumstances. So right now it's time for the traders, I think, to carry the load.
Tech firms said that if your employees work from home, they're actually not going to cut their pay because they have to pay more to keep the employees at the company and they don't want to lose the talent. Do you get the same feeling that banks too are going to be competitive in that way?
I think banks do have to be competitive in terms of pay, and for sure, I think the rock stars this year are going to be, handsomely compensated relative to what they've done for the banks. But I think it's going to be a lot more varied, a lot more spotty. The recruiter we talked to said it's going to be very messy this year, given the kind of divergence in performance across multiple desks. So it's not going to be a very straightforward story of, the rising tide lifting all boats. It's going to be some people getting cuts, some people getting zeros, and others getting big bonuses. So it's going to be very, very diverse across the street.
All right. What's my bonus going to be, Lenan? Do you know?
Bitcoin.
Bitcoin? All right. Bloomberg's Lenan. She's speechless. I guess that means zero. Bloomberg's Lenan knew it. They're giving us that update there on what Wall Streeters can expect with regards to bonus season this year. Let's take a look here at the broader market here as we get ready to count you down to the close. Taylor, 37.27 on the S&P 500.
We have much more next as the small caps those continue their underperformance. This is Bloomberg.
Live from New York, we're counting you down to the close. 1 hour left in the trading day. I'm Romaine Bostick.
I'm Taylor Riggs. Caroline Hyde has the day off today, but we still got you covered.
Yeah, we have you covered, Taylor. I would never leave you in the lurch here. Let's take a look at where the U.S. markets stand right now. Off the highs of the day here, we opened pretty much around a record high, but again, taking a little bit of a breather. We should point out volume relatively low. You're really the only activity you're starting to see here is a lot of the healthcare names. No real news there, but a lot of the device makers are rallying today, but not much else. You see industrials, energies, pretty much the main laggards here. If we flip up the board here and go over to some of the individual movers, the talk of the day has really been about Apple. Apple, of course, flirting with those record highs once again, pulling back a little bit at the moment here. But of course, everyone is sort of looking to see what the next leg up for this company is. An 80% rally this year. That's on top of an 80% rally the previous year. Snap also traded at a record high at one point on the day, pulling back a little bit, but still up 5.5% on the day. Keep an eye on Lemonade. That lockup expired. Remember, this is a float of about 16 million shares here, Taylor, and you got about 44 million that potentially could be released this week should folks actually decide to sell. And Fubo TV, another lockup expiration for folks to keep an eye on here.
I still have that song Lemonade in my head.
Yeah. Well, it was a popular drink, and it still is.
Let's take you from drinks on over to volatility, Romaine, because while we removed some of the uncertainty risk with the elections, a lot more remains. Take a look at this quote. This is from Stuart Kaiser, over the head of equity derivatives research. He's saying that the bipartisan stimulus bill driving a sizable upward revision to their growth estimates. That has removed uncertainty, but other risk still remains. He talks about slowing U.S. data, the Georgia runoff, maybe some scar tissue from 2020. That's leaving option premiums really high. Romaine, this is as we take a look at a spot VIX up about 2 points today. That's not much, except spot VIX still 12 points above realized vol. So you're getting future implied vol still higher than what's actually being realized in the market. So there could be some more uncertainty on its way.
All right, for more insight into what's happening in the market and beyond, let's bring in John Buckingham. He's portfolio manager over at Kovitz. John's also, of course, the editor of the Prudent Speculator. and joins us today from Laguna Beach, California. John, great to have you here on the program. I guess we'll start with the basic question I think everyone has on their mind, coming off what is probably, I guess by many measures, an improbable rally this year. And I guess people would just want to have some sense here as to whether there's some sustainability of this rally deeper into 2021.
Well, I certainly think there is. Valuations for the majority of stocks are very reasonable. Interest rates are extraordinarily low, which should make stocks more interesting to investors, especially dividend-paying stocks. And the economy is likely to have much better growth next year. You know, the Federal Reserve is suggesting more than 4% growth in 2021. So while there certainly are areas of the market that are very frothy and expensive, I really think that the average stock is inexpensive, and value stocks, inexpensively priced stocks, are very attractive today.
Talk to us about that, because when you note the value sector, we think some of the smaller caps, the Russell 2000, a lot of people saying that this breather is good given a slew of record highs and coming off some of the best months that it's had. So does that still look cheap?
Well, yeah, small and mid-cap stocks have lagged behind significantly. You know, this has been a very narrow rally in terms of the biggest winners. You know, you mentioned Apple, and Apple is our largest holding. You know, we own that stock, but you know, big caps have been what's driven the market higher, and the average stock has not had much of a gain this year at all. So again, I think small caps, mid caps, dividend-paying stocks are very attractive, and I think investors will gravitate toward those as we start to see some better economic numbers. And of course, that all stems from the pandemic starting to fade as vaccines really take a hold.
You know, John, a lot of people are kind of looking for sort of that next sort of big transformational market opportunity. The idea here that you had these work from home stocks, you had a lot of cloud names, and just a lot of technology names and even non-technology names that sort of made a case that they could sort of be the next Apples and Alphabets of the world here. Are you seeing those type of sort of transformational opportunities out there right now?
Well, we've owned many of those names. You know, they were value stocks to begin with, things like Target, you know, Lowe's. We like a smaller cap home builder called MDC Holdings with a big dividend yield. So there are opportunities in the home, the work from home, the live at home, and certainly technology is a place where we think will continue to benefit. And as a value manager, we are very much overweight technology, but we think we're overweight, you know, reasonably priced technology. You know, Apple, Microsoft are big holdings for us, but a company like Juniper Networks, which is trading at a PE of 13, 14, buying back stock, a dividend yield of over 3.5%, and should still benefit from some of these longer term trends in technology that we think will drive, you know, even the big caps higher. But some of the lesser known names, I think, have much greater upside potential from here.
Can some of those big tech names that you mentioned, as well as the value that you like, both benefit, though, if rates tick up a little bit?
Well, interestingly, rising interest rates have actually been a positive for value stocks, as you might imagine, given that many financials are value stocks and they do better in rising rate environments. But we crunch a lot of data and numbers in our shop, and when we look at rising rates and value returns and growth returns, value's done really well relative to growth in rising rate environments and in rising inflationary environments. So we do think that a spike up or even ticks up in interest rates will actually be good news for value stocks.
What about the rest of the world? I mean, a lot of focus is here on the U.S. markets and what it offers investors here. When you look overseas, and whether it's developed markets like in Europe or even some of the emerging markets in Asia, and I include China in that basket as well, do you see reasonable opportunities there?
Right. Well, one of the areas of focus for us is on international stocks via American depository receipts or U.S. companies that derive a lot of revenue overseas. So yes, the foreign markets have lagged behind. So there are opportunities. You know, we own, again, many stocks in our portfolios, 80 or so stocks on average. And so we're going to have 7 or 8 ADRs in our accounts. One that I like in particular is a big French drug maker, Sanofi. Again, a dividend yield, so there's a common theme here. We like yield, over 3% yield there and a very reasonable valuation, and we think a solid drug pipeline. So there are a lot of opportunities around the world, and you know, we're always looking for what's the next big thing. I know that it's been a good year for the overall market. It's been a good year for us as well, relative to value, especially. But you always want to think about what's going to happen going forward. And we like to go where the opportunities are, the bargains are. And I think there are bargains in the foreign markets, and U.S. investors can participate in them.
As long as you get that dollar weakness. John Buckingham of Kovitz, thank you as always for your time. Appreciate it. And coming up, well, not so confident, why China is struggling to get the world to trust its vaccines. We have the latest. Plus, well, betting against that dollar, why speculative traders are ending 2020 doubling down on the greenback to the highest in almost a decade. And will it be sour for lemonade next year? Why the insurance app might enter 2021 with some extra volatility. All that and much more coming up. This is Bloomberg.
All right, welcome back to Bloomberg Markets to Close, counting you down to the close. 48 minutes to go here in the trading day. The S&P 500 coming off those record highs from yesterday, tried to extend those gains today, but ran a little out of steam here on the day. You see sort of the sentiment here right now, though, reflected more in some of those small cap and cyclical names. For a second straight day, we're seeing that underperformance in the small cap space. We should point out a lot of these names that we're seeing in the Russell 2000 as a lot of the biotech names really getting sold off here as well. The FANG stocks holding their own. So you're seeing Amazon, Facebook, Netflix move higher. The biggest gainer in the FANG index, Alibaba up 7%, the ADRs here, and you see that reflected in the KWEB, the Korean shares index, the ETF, I should say, that tracks, of course, a lot of those Chinese tech names, which had sold off pretty heavily over the previous 2 days, gaining back some of those losses today. You flip up the board here and take a look. This is the interesting story here. There's your 10-year yield, the first line. Your second line, that's your real yield. You take the difference between those two, a negative and a positive. Well, you get inflation expectations. Inflation expectations right now, your 10-year break-evens reapproaching that 2% mark. Got really close to it yesterday, not quite there today, but that's why you're seeing that weaker dollar here, the Dixie down on the day, and that's why you're seeing those continued bets for further dollar weakening into 2021. Bitcoin taking a little bit of a breather here after flirting with those record highs earlier in the week. Taylor.
Well, we're going to go from your favorite topic of Bitcoin to your favorite geopolitical story, and that is Brexit, Romaine. The European Parliament giving the final vote on the EU-UK trade deal at a later stage, which could be extended until March. Bloomberg's Maria Tadeo spoke exclusively with David McAllister. He's the member of the European Parliament and head of the UK Coordination Group.
This agreement will be operational on the 1st of January. This means certainty and clarity for businesses and citizens. It will be applied on a provisional basis, but what this means is that the European Parliament will give its final consent at a later stage. In the moment, in the draft text, the two sides have agreed that the provisional application will last until the 28th of February. So the European Parliament could vote on the 23rd of February. If the European Parliament needs more time to scrutinise the text, then the British side and the European side would have to agree for a further extension of this period. But the clarity for businesses and citizens begins on the 1st of January. And I welcome that the member states are now green-lighting this agreement, because this all avoids the negative consequences of a no-deal scenario.
And you make it clear that you want to take a look at the deal and you want to do it in detail. What areas specifically do you want to really focus on?
Well, we got this agreement as a kind of a Christmas present on Christmas Eve in the afternoon, and I have had time over the Christmas holidays to have a look at the about 1,300 pages. What I've read until now, I must say this seems to be a fair and balanced agreement. It's a good agreement for the European Union because this draft agreement protects our citizens, it protects our single market, and it protects our long-term economic interests. However, even with this agreement, EU-UK trade and agreement, UK-EU trade and cooperation will not be the same as before. We are expecting big changes on the 1st of January, but this, of course, is the result of the decision of the UK to leave the European Union, the single market, and the customs union.
Right. And since we're on Bloomberg, I do want to ask you about financial services. It's interesting that the Prime Minister did say perhaps we didn't get everything that we wanted from this, but we could perhaps revisit that in the future. Do you see or foresee a situation where the European Union does that? When they go back on the deal and they agree on just giving the UK more rights on that financial services industry and do this periodically, is that something that could potentially happen?
The European Union and the United Kingdom will now form two separate markets, two distinct regulatory and legal spaces. And of course, this will recreate barriers to trade in goods and services and to cross-border mobility and exchanges that have not existed for decades, in both directions, affecting public administrations, businesses, citizens, and stakeholders on both sides. But these are unavoidable changes as a result of British politics to leave the European Union, the single market, and the customs union. Now, what does this agreement mean for financial services? Well, this agreement covers financial services in the same way as they are generally covered in the European Union's other free trade agreements with third countries. But this agreement doesn't include any elements pertaining to equivalence frameworks for financial services. These are unilateral decisions of each party and are not subject to these negotiations.
All right, David McAllister there, of course, member of the European Parliament and head of the UK Coordination Group, speaking a little bit earlier there with our very own Maria Tadeo. All right, now time for Options Insight with our very own Abigail Doolittle. And Abigail, you're taking a look at that small cap sell-off today.
It's hard to ignore, Romaine, now that we have the Russell 2000 down 3 days in a row, the longest losing streak since the end of October, the biggest losing streak since the end of October. And I know Matt Rao of Headwaters Volatility, CIO of Headwaters Volatility, that pullback, the pause here for small cap has caught your eye too, because there's been the quote-unquote froth there. It's pretty amazing that Russell 2000 has literally doubled from that March low, actually outpacing the NASDAQ 100 at this point.
Yeah, it is. And, you know, you can look at December on a standalone basis and see that small caps, as represented by the Russell 2000, have done extremely well, even including today's sell-off. I believe they're up a little over 6% since December 1st. But it really falls into what I would categorize as the way that people are taking risk as opposed to whether they are or they aren't taking risk. You know, people like to be long stocks that can double. It's one of the reasons why value strategies have suffered as much as they have. So on a day like today, I think you're seeing people not necessarily de-risk their portfolio, but they're changing the way that they're taking risk, and they're taking some profit on those small cap December rally, and you know, maybe reallocating it into names like Amazon on a day like today.
Well, I know in the past that you've told us that super low yields, of course, are a big piece of why investors are stretching into new areas of risk. We'll have to talk about that another time, because something else that's really standing out at this point is the skew index, which is sometimes called the panic index, really out of the money puts. It is spiking back to the levels earlier this year, I should say the end of last year, ahead of this year's bear market, and then back in 2018 and 2016. It's a pretty accurate timer more recently of corrections to come for the S&P 500, but usually, you know, a month to 2 months in advance. What are you seeing here? Does this make you more concerned about the possibility that there is some froth for stocks? Yeah, it does. And, you know, there is something to consider here, the year-end effect of how people want to paint their portfolios as far as how hedged they are or aren't going into the end of the year. But I do think that there is some validity to this, especially when the put-call ratio is where it is. And, you know, pricing is looking this way. So people that I'm talking to are cautious. They feel like they're more long equity exposure than they want to be, but they feel like they have to for career safety reasons. And, you know, I think there's validity to that signal. So it sounds like some caution and some complacency with that put to call ratio. And so I know that you want to be long vol, small cap vol. Yeah, I think, you know, I like the trade of selling call spreads on the Russell 2000 and the IWM to fund buying put spreads. You know, it can be a way to de-risk your portfolio without bleeding a lot of premium, as they say. But I do think that if you do get a risk off or a change of risk attitude, that we're likely to see some pretty significant underperformance out of the small caps. And so this would be a nice strategy to play that. Well, Matt, look forward to chatting with you. Happy New Year, because I know this will be our last conversation of this year, and hopefully in the new year we'll talk yields, which I know you love to talk. Matt Rao of Headwaters Volatility, thanks so much for joining us for Options Insight. And from New York, this is Bloomberg.
We're going to get the story of dollar weakness in about 10 minutes, but until we do that, we can fold that over into the equity markets because dollar weakness has certainly been a boost to some of the EM stocks. As you can see here, Romaine, this is the emerging market ETF. It is back almost near record highs you had on the 17th. That, of course, was the big record, but it has been pretty much an everything rally, a lot to do with, of course, handling on the virus, some of the vaccine rollouts. So for more on EM and all things FX and equities, let's bring in our own Bloomberg's Sherry on. Sherry, what's behind the rally?
Yeah, and all things also to do with Alibaba because we saw that huge sell-off, and right now with Alibaba having the heaviest weighting on the MSCI Emerging Market Index with 7%. The rally in Alibaba right now, which is gaining the most since July, helping really with the emerging market equity sphere. And of course, this coming at a time when we saw a huge sell-off given this antitrust scrutiny, but investors have said perhaps this could be a buying opportunity. Sources also talking about Ant Group, the affiliate that its IPO has been shelved, but they're folding their financial operations into a holding company that could be regulated more like a bank, so perhaps a little bit more clarity on that front. When it comes to emerging market FX, we are seeing the Brazilian real rallying, the Turkish lira rallying, with the Brazilian unemployment rate climbing for the first time in about 10 months, and the lira also continuing to rally right now, given the rate hikes and more confidence on their new economy team.
Yeah, so Sherry, I mean, we talk about the vaccine optimism out there. I mean, there was a great story on the terminal, of course, about how there's some concerns about from certain countries in accepting the vaccine that's being produced by Sinovac and some of the Chinese companies.
Some of the Chinese companies, also some of the Russian companies. But let's talk a little bit about the Chinese mistrust out there when it comes to those vaccines, because one of the key points that China wanted to gain from this pandemic was diplomatic vaccine win by supplying to these poorer nations. But we have seen mistrust growing on China's vaccines, given, not to mention earlier this year, compounded by China's exports early in the pandemic of subpar tests and personal protective equipment. Still, China's foreign ministry saying that the vaccines strictly comply with the law and clinical trials in the first 2 phases, showing that the shots were safe and effective. And here's what the foreign ministry spokesperson Zhao Lijian had to say over Twitter, which was really interesting. It may be the only choice when it comes for governments that haven't secured supply so far. It's estimated that of all the 12 billion vaccines to be produced globally next year, the wealthy countries have booked 9 billion. So for most countries that haven't got any vaccines, the Chinese made ones maybe their only choice.
We were also showing photos there of Sputnik 5, Russia's vaccine making its way onto an Argentinian airplane. Does Argentina say that they have no other choice, as you sort of alluded to in that tweet, but to accept any vaccine that they can?
They're very confident about the Sputnik 5 vaccine, but you said it, there has been skepticism about the Russian shot as well, especially after the fact that President Putin approved its use without the results of their final stage clinical trials. We still have seen Argentina take those shots. 300,000 people are expected to be inoculated in Argentina starting today.
All right, Sherry on. Always great to have you. Emerging action there. Of course, you can always check out Sherry every night right here on Bloomberg Television. All right, let's get a check here on what's happening in the broader markets here in the U.S. as we count you down to the close. A little more than 30 minutes to go. The S&P 500, call it flat on the day. The Russell 2000 been under pressure all day, continuing those losses from yesterday. FANG stocks getting a little bit of a boost. Alibaba, ADRs up 7%. This is Bloomberg. All right, about a half an hour ago here in the trading day. This is the countdown to the close. I'm Romaine Bostick.
And I'm Taylor Riggs. Caroline Hyde has a well-deserved day off, but we still have you covered. As we just mentioned, about 30 minutes ago, and remain certainly a defensive tone underlined the individual sector levels that we can see with the S&P 500 off the record highs yesterday. You do have healthcare, some of the big tech up in the lead, and on the bottom, Romaine, really is the risky tone. real estate, energy, industrials, those are the big laggards dragging us down off those record highs.
Yeah, and take a look at some of the individual movers. Of course, a lot of people talking about Boeing. Those shares had been beaten down. They've actually seen a little bit of a revival. The 737 MAX getting its first commercial flight here in the U.S., going from Miami to LaGuardia and back again. A very symbolic move here for Boeing. Of course, the travel industry is still under pressure. Intel also rising. Of course, we had that news that Dan Loeb, his hedge fund, Third Point, actually seeking changes in Intel, strategic options, if you will, potentially even a breakup of the company. We'll see. Investors trying to jump on the back of that, trying to jump on the back. Amphastar as well, the FDA giving approval to that hypoglycemia drug. That's giving a list to the shares there. And keep an eye on what's been going on in Bitwise. Of course, that's that new vehicles, kind of not quite an index, not quite an ETF that allows you to invest in crypto. It's gotten caught up in that whole drama with Ripple and XRP. They basically had to sell off the holdings of XRP because of the regulatory issues that were tied to Ripple. The shares of this fund are down right now about 7.5%, Taylor.
And we go across asset, we have to take a look at the dollar. We're looking at dollar weakness to levels we haven't seen really since April or May of 2018. That has been the story and really the trade all year with central bank intervention, but you see the trade in speculative positions. Now, bear with me. This is large speculative dollar net positions. Now, that's the most short since earlier this year, and then you have to go back to May 2018. But there's another number that we're also citing as well. General non-commercial positions, those also have the biggest net shorts since March of 2011. That is almost a decade. Hard to fight the trend. Every strategist we've spoken to says dollar weakness is the trade for next year.
Yeah, well, looking at that chart, you can see everyone pretty much believes that. Whether they're going to be right or not remains to be seen. Now, let's get some insights here from Jens Nordvig. He's Exante Data founder and CEO, joining us right now. Let's start there, Jens. Everyone's talking about dollar weakness, the idea that it is going to persist into 2021. Is there any sense here that maybe all those people are right?
So the first thing I would say is that it's sort of common that you do year ahead outlooks and then you sort of have to come up with a narrative, and then a couple of weeks into the new year, all those narratives fall apart. But this cycle is a bit different, right? We've had some huge macro moves in 2020. And going into 2021, we're also going to be seeing some big macro moves. So it's not going to be little wiggles. So I think there's a better chance that a big move in the dollar is really potentially ahead of us. And it doesn't matter so much that a number of people are writing about it at the same time, because it's a big move. It's not like a little wiggle. And I would also say that when we look at positioning, and we have a lot of proprietary data we look at for positioning, it matters a lot of what you look at. So you made a reference to what is going on in the futures market, and clearly there's a very significant amount of dollar shorts in the futures market. But if you look at the real money community, if you look at the positions there, the real money community was really long dollars aggressively early in the year, and they've been getting back to neutral. But I don't think it's the case that there's like a huge dollar short in the big real money community. And those are the investors that can add to dollar short positions in coming months, coming quarters, and help sustain the dollar weakening trend.
I want to talk about the sort of economics behind this. A lot of people have said, of course, and we heard it a little bit from Trump in the last 4 years, dollar weakness, it lowers the value of the goods so that you can export them, and other countries find it cheaper to buy here. So that could be a good thing. But then, of course, other economists say, like Janet Yellen, the incoming Treasury Secretary, you want a strong currency, a sign of strength. Where are you then on the economics of what it means to have dollar weakness versus dollar strength?
I think from a trade perspective, it's pretty clear that having a more competitive dollar would be helpful over time. But the U.S. is not a country that is sort of competing on cost in a lot of sectors. Just because we have a somewhat weaker dollar doesn't mean that we can suddenly start to compete in textiles and all those types of things. So the dollar really needs to move quite significantly for that to have a big impact on trade. And the dollar was very strong. Like if you think about where the dollar was in March, April this year, it was very, very strong compared to levels we saw back in 2014. So the dollar has a long way to go before it starts to get competitive again, starts to get a real gain on that front. So we've just started the dollar weakening, so to say, over the last 6 months. And typically when you have these cycles, they can run for multiple quarters at least, and sometimes multiple years. So I think it's fair to say that if we have a global environment where the global growth outlook is improving, obviously from a very weak starting point, but improving and improving further, that's really the environment where you have investors in the US getting comfortable with international risk assets, putting capital to work, and sustaining a weak dollar trend.
And at the same time, Jens, there's sort of a lot of conversations out there about inflation, or at least inflation expectations, the idea that those expectations are starting to move maybe a little bit closer into the near term than maybe what it was a few months ago. I am curious that given all the talk about fiscal stimulus, the potential that you could have a new presidential administration and a new reshaped Congress that is willing to expand that fiscal stimulus, that fiscal support. Do you worry at all about the impact of inflation and I guess the timing of it?
So in the short term, I don't really have any major concerns about inflation. We're still in an economy where there's spare capacity and we can have a lot of growth before we get into those capacity constraints. But I think what is worth thinking about is, are we entering a new political regime? And I think today's news cycle is very interesting, where you have GOP senators pushing aggressively to get an extra $2,000 in stimulus checks emailed to a broad set of the population, right? There is something new going on with the debate about fiscal stimulus. And if that becomes a persistent trend where we can get political support behind backing aggressive fiscal stimulus, then we can enter a new regime where maybe on a multi-year horizon, we need to think differently. And we can already see that in the market to some degree, right? Because there's certainly less concern about deflation than there was. Break-even inflation is going up towards 2%. And that means the real interest rates in the US are compressing. And that's part of the dollar weakening story too, that real interest rates are actually going down in the US, and around the world, they're not moving very much because they had already hit a low level a couple of years ago.
Our thank you, as always, Jens Nordvig of Exante Data, and of course his 2013 book sitting nicely behind him, The Fall of the Euro. That'll maybe be something I'm going to have to read. Thank you, as always, for joining us. We appreciate it. And we just want to check, of course, on the markets as we come into the closing bell. You kind of heard it there. It is a risk-off tone, with tech as the big defensive name. Small caps are lower, but you have a drift up in VIX, and, well, you heard it here, dollar weakness. This is Bloomberg.
All right, we're talking about Lemonade, the insurance provider. Shares have had a volatile week. Shares are the best performing listing of 2020, actually, rising today. Second round of insider selling restrictions expiring. For more, let's bring in Bloomberg's Drew Singer to talk a little bit more about what's going on. Drew, Lemonade, of course, this was a really popular listing when it hit the market. We're seeing this lockup expiration here, and the difference, I'm just amazed at the difference between the current float that's out there and the amount of shares that are at least eligible now to be sold into the market should some of those investors choose to do so. What's going on?
Yeah, and that's something that investors seem to have been anticipating as well. We saw a decent sell-off yesterday in Lemonade heading into the lockup expiry that might have been tied to traders saying, you know, just in case tomorrow is a little volatile, let's collect our gains now. I mean, the stock is trading about quadruple its initial public offering price in July. This has been a really hot year for IPOs, and Lemonade is certainly the hottest.
Interesting, though, analysts on the street are a little mixed. I think a few have called the valuation a little bit high, of course, after the run-up. But then a Piper Sandler analyst said that they do remain positive on the long-term opportunity. The company warrants an expanded multiple. What is the consensus out there about the multiple at this moment?
Yeah, there's still a couple bulls still out there on Wall Street. They have an average price target around $80 right now, which is pretty significantly less than what it's currently trading at, which is closer to $120. So in general, Wall Street thinks this stock is trading a bit higher than it's worth. This is still an unprofitable company, but I think investors are looking kind of longer term, and they're excited about new markets like pet and auto. Traditionally Lemonade has focused on renters and home insurance. So there's quite a growth story behind this stock.
Yeah, that's cute that you bring up profitability, Drew. I mean, it seems like I feel like the majority of the listings that we had this year, and it's been a record year, of course, most of these companies are unprofitable. The overwhelming majority of them are, Drew. Is there any sense here that the willingness for investors to embrace these names the way they did this year, that's going to continue into next year?
Yes, there is, and I think that's part of the risk-on trade that we've been seeing kind of throughout the market near the end of 2020, heading into 2021 with stocks pressing to all-time highs. I think this is investors looking beyond the uncertainty we've had the past year related to both the pandemic as well as the political situation in the U.S., and they're hoping for better times ahead.
Drew, I'm going to sort of follow on what Romaine was saying, not to be a naysayer, but there's been this consensus, and I'm wondering if you two hear it, that when I grew up, profitability meant net income. And now it seems like we're just moving up the income statement, and to be profitable, you only have to be EBITDA positive. Has that narrative changed, or am I crazy? Speechless.
You left
Romaine,
them speechless.
Speechless. The way you left Lennon speechless when you asked for a bonus.
Taylor.
I can't talk about profitability
Drew
anymore.
couldn't hang. Well, you're the runner. You can go the distance. Anyway, our thanks to Drew Singer, of course, who covers this. And I mean, in all seriousness, Taylor, I mean, IPOs, obviously, when you look at the data, I mean, just crazy. Not only just in terms of the IPOs themselves, but you talk about a record for secondary listings and, of course, a record this year for SPACs.
And we have our favorite IPO ETF, our favorite SPAC ETF, both outperforming the S&P 500. We are getting some comments from the incoming President Joe Biden. Take a listen.
As we end one of the most difficult years as a nation, I remain optimistic about our future. The vaccines have been discovered and developed, and there's more to come, we believe, give us enormous hope. Our economy is poised to come back and come alive. And I can see a return to normalcy in the next year. I also see incredible opportunities for our nation in the years ahead, in job creation, clean energy, racial equality, and much more. But we need to be honest. The next few weeks and months are going to be very tough, a very tough period for our nation, maybe the toughest during this entire pandemic. I know it's hard to hear, but it's the truth. As Roosevelt said, I think the American people can take whatever we tell them if we tell them straight from the shoulder. We need to steel our spines for what's ahead. We need to follow even more closely the recommendations to slow the spread of the virus. And each of us needs to do what we can to protect ourselves, our families, and our fellow Americans. We're going to get through this. Brighter days are coming, but it's going to take all the grit and determination we have as Americans to get it done. So today, I want to be clear about 5 things every American should know about our efforts to contain COVID-19 and where the vaccine stands today. First, things are going to get worse before they get better. In September, we passed a grim milestone, 200,000 deaths. At that time, in this very room, many of you remember, I warned that we'd hit 400,000 deaths before the end of the Trump administration in January. Critics said I was being too alarmist and negative. But as I've said all along, I will tell you like it is when it comes to COVID. And the reality is, it looks like that we're going to hit that grim milestone. We've just crossed 330,000 deaths in America. We're averaging daily death rates of nearly 2,200 people, which means we'll lose tens of thousands of more lives in the months to come. Hospitals are being stretched beyond capacity, and that's data before we see the impact of the cases coming from the recent holidays and this upcoming holiday of New Year's Eve. People getting infected today don't show up in cases for weeks, and those who perish from the disease die weeks after initial exposure. So we have to anticipate that the infections over the holidays will produce soaring cases counts in January and soaring death tolls into February. You know, turning this around is going to take time. We might not see improvement until we're well into March, as it will take time for our COVID response plan to begin to produce visible progress. The second thing to know is the Trump administration's plan to distribute vaccines is falling behind, far behind. We're grateful to the companies, the doctors, the scientists, the researchers, the clinical trial participants, and Operation Warp Speed for developing the vaccines quickly. But as I long feared and warned, the effort to distribute and administer the vaccine is not progressing as it should. A few weeks ago, the Trump administration suggested that 20 million Americans could be vaccinated by the end of December. With only a few days left in December, we've only vaccinated a few million so far. And the pace of the vaccination program is moving now, if it continues to move as it is now, it's going to take years, not months, to vaccinate the American people. Which brings me to the third thing every American should know. The Biden-Harris administration will spare no effort to make sure people get vaccinated. I've laid out 3 challenges in our first 100 days. One of them is ensuring that 100 million shots have been administered by the end of the first 100 days. If Congress provides the funding, we'd be able to meet this incredible goal. It would take ramping up 5 to 6 times the current pace to 1 million shots a day. But even with that improvement, even if we boost the speed of vaccinations to 1 million shots a day, it will still take months to have the majority of the United States population vaccinated. I've directed my team to prepare a much more aggressive effort with more federal involvement and leadership to get things back on track. We'll find ways to boost the pace of vaccinations. But as Dr. Fauci and others have stated these past few days, this will take more time than anyone would like and more time than the promises from the Trump administration have suggested. This is going to be the greatest operational challenge we've ever faced as a nation. But we're going to get it done. But it's going to take a vast new effort that's not yet underway. And to get things, and that gets me to the fourth thing that we should know. I'm going to move heaven and earth to get us going in the right direction. I'm going to use my power under the Defense Production Act when I'm sworn in order private industry to accelerate the making of the materials needed for the vaccines, as well as protective gear. Vice President Harris and I have been speaking with county officials, mayors, governors of both parties to speed up the distribution of the vaccines across the nation. We're planning a whole-of-government effort, and we're going to work to set up vaccination sites and send mobile units to hard-to-reach communities. And we also know there's a vaccination hesitancy in many communities, especially Black, Latino, and Native American communities, who have not always been treated with the dignity and honesty they deserve by the federal government and the scientific community throughout our history. That's why we will launch a massive public education campaign to increase vaccine acceptance. We'll do everything we can to show the vaccines are safe and critically important for one's own health and that of their families and the communities. That means we're also going to make sure vaccines are distributed equitably, so every person who wants a vaccine can get it no matter the color of their skin or where they live. And we're going to ensure vaccinations are free of charge. Fifth, while the pandemic rages on, and as we increase the supply, distribution, and administration of the vaccine, we have to remain vigilant. As part of the 100-day challenge, I'm going to be asking the American people to wear a mask for the first 100 days of my administration. It's not a political statement. It's a patriotic duty. Our administration is going to require mask wearing where I have the power to do so, for federal workers, in federal facilities, on interstate travel like planes and trains. And we've been working directly with county officials, mayors, governors to implement mask mandates in their cities and their towns and their states. Masking has been a divisive issue in this country. But COVID is a killer in red states and blue states alike. So I encourage you all to wear a mask. Encourage your family and friends to do the same. It's one of the easiest things we can do that will make a huge difference and to save lives. Another 100-day challenge is opening most of our K through 8 schools by the end of the first 100 days in the spring. Look, we can only do that if Congress provides the necessary funding so we get schools, districts, communities, and states the resources they need for those so many things that aren't there already in a tight budget. They need funding for testing to help reopen schools, more funding for transportation so students can maintain social distances on buses. They need it for school buildings, for additional cleaning service, protective equipment, ventilation systems. This is going to require an additional of tens of billions of dollars to get this done. And Congress also needs to fund and provide more protective equipment for frontline health workers who are still reusing masks and gowns. We need to scale up testing so anyone who needs one can get a test. After 10 months of the pandemic, we still don't have enough testing. It's a travesty. All this, vaccinations, testing, protective gear, is going to require more funding from Congress, more than was just approved. That's why I'll propose a COVID action package early next year and challenge Congress to act on it quickly. Look, my ability to change the direction of this pandemic starts in 3 weeks. With thousands dying every day between now and then, let me conclude by discussing what needs to happen now. I congratulate the bipartisan majority on passing the president's and then the president on signing the COVID relief bill. It's still, it's a step, an important step, still moves in the right direction. And it will help people in need. And it'll pay for some, but not all of what we need to fix the COVID response. It's a down payment. But now, with that done, I hope the president will also clearly and unambiguously promote mask wearing. I give former Governor Chris Christie credit. He and I have disagreed in a number of things. But I'm thankful he's now encouraging people to do the right thing and wear masks for themselves, their loved ones, and their country. I hope that President Trump will listen to him. He can do it too. It would make a huge difference for President Trump to say, wear masks. I hope the president will clearly and unambiguously urge all Americans to take the vaccine once it's available. I took it to instill public confidence in the vaccine. President-elect Harris took hers today for the same reason. And when the president's doctors recommend it, President Trump should take it and instill the same degree of confidence. Let me also say this to the American people. We can save, all the experts tell us, between 60 and 100,000 lives in the weeks and months ahead if we just step up together, wear a mask, socially distance, wash our hands, avoid large indoor gatherings. I know all these are not easy to ask, but I'm asking you to make a sacrifice. You're already making tremendous sacrifices every single day. It's hard on your lives, on your livelihoods, on your kids, on your families. It's not small what we're asking of you, but we're in this together. And the actions we take now are going to help us contain the pandemic and get us back to our lives and to our loved ones. So the American people, to all of you, I know there's a lot that we have to do, but I want you to know there's also much we can do. We're the United States of America. We've been through hard times before as a nation, and we'll come through this as well. I promise you we will. So please, I wish you a Happy New Year. May God bless you and may God protect our troops. Wear a mask.
That is President-elect Joe Biden making remarks in Wilmington, Delaware, all about the vaccine. Romaine, really nothing new. We've heard a lot of this before. Dark days ahead. He wants to vaccinate in his first 100 days 100 million people. He wants to create mask wearing for the first 100 days, really wants to propose a COVID package early next year. Part of that will include testing funding that requires tens of billions of dollars, but needs the testing to help reopen schools and to launch an information campaign about the vaccines. In the meantime, we do have a lot going on in the markets. Take it away.
Yeah, I mean, and let's get back to the markets here. I mean, you're looking at the major indices here, getting ready to close here on the day, closing down. Remember, all of these indices were at record highs yesterday. A little bit of a pullback. We should point out volume is light. In fact, it's actually lighter today than what it was yesterday. And it's well below the average that we've seen over the past 3, 6, and 12 months here. But to the point that you were making there, Taylor, and specifically with what Biden was getting at too, is the idea of reopening the economy here. And there was a great story on the Bloomberg today that talked about a lot of the mobility data out there that has shown a real drop-off in activity. A lot of this, of course, is because of the holidays, but also because of the rise in COVID cases and the winter months here. And of course, he started off that speech, that statement today by saying things will get worse before it gets better. And I think that's what you're seeing right now, Taylor, with the market sort of trying to sort of wrestle between some of these short-term concerns and I guess some of the longer-term optimism about valuations and things.
Yeah, and we're lucky that we have Brian Levitt here, who's with us to break all things down in the market. Brian, thanks for being patient with us as we're sort of navigating the world of politics with the world of markets. Brian Levitt, of course, Invesco global market strategist. Talk to us sort of just broad. I want to get out of the day-to-day and sort of how you're thinking about where we ended with stimulus. It then kind of feels priced in, but then you have the Russell 2000 knocking off the highs in the past few days. How are you thinking about these markets? What's priced in, what's not as we wrap up 2020?
Yeah, so the markets were expecting some type of fiscal deal, and we got that now. We're moving past Brexit. We've moved past the election, so a lot of the political uncertainty starts to abate. The reality is now, as you're talking about, we're dealing with a rise in COVID cases, a slowdown in mobility, and the market was well aware of that. The market's been expecting that. The question over the next weeks is, does it get worse relative to expectations? But what's more important for investors is the next couple of years. And this is an economy that fell to a depressed level. It's recovering. The output gap is still wide, meaning policy is going to be accommodative for years to come. It suggests a good backdrop for risk assets. It doesn't mean that there's not going to be some challenges as we progress over the next couple of years, but markets should continue to go higher.
And with all the sort of the debate right now going down in Washington, and of course all the people who watch Washington with regards to fiscal stimulus and sort of what's the appropriate amount to stimulate the economy, and maybe what's too much that would, I guess, maybe have a negative impact here. Does that give you any concern right now that maybe policymakers aren't necessarily making the right moves, I guess?
Well, we got the first agreement through, and so that was important. And whether you want to put that right number at 900 billion or 2 trillion, we could debate that. I think it has real implications for the economy. It has real implications for American households. It has real implications for small businesses and select municipalities. But the reality is the markets are going to be focusing on a recovery, and that recovery is going to play out whether it's $900 billion fiscal deal or $1.5 trillion fiscal deal. We felt it with depressed level, and this economy is going to recover over time. The extent of the fiscal support tells us how strong this economic recovery is going to be. So I would tell investors to think back to the period in the aftermath of the global financial crisis. We got the fiscal deal. Many said it wasn't large enough, and we ended up growing at a pretty slow pace for a lot of years, which was not great for the real economy, not great for job creation, not great for wages, but ended up being quite good for markets because a modest growth, benign inflation environment can be supportive for risk assets. And so I suspect we're heading back into a similar environment as that.
Romaine has been doing some smart analysis today, Brian, on inflation and the relationship with equity markets as 10-year break-even start to approach that 2% level. Higher inflation's good for higher stocks, even if it means higher yields?
Yeah, I'm not worried about high and rising inflation at this point, Taylor. I mean, high and rising inflation would be probably a high quality problem at this point. I mean, we were staring at the deflation abyss. We responded to it. things are starting to improve. It's nice to see inflation expectations back to where they are. But remember, we've got cyclical challenges. We've got high unemployment. We've got a big output gap. That should all keep a lid on inflation. We also have secular challenges with an aging population globally. So I don't view inflation as something that's going to get out of hand and put pressure on equity multiples. I believe that this improvement in inflation expectations is really indicative of the policy support that we've had, the success of the policy response, and is in line with this idea of an improving economy, and one that should be supportive for the reflation of asset prices, not necessarily of goods prices.
Yeah, and I saw some data that Invesco had put out showing just the amount of fiscal support as a percent of GDP out there, and the U.S., of course, leading the way on a percentage basis, outpacing a lot of other countries there. Brian, I am curious when we talk about the consumer side of the equation, consumer spending. Obviously, that's been reshaped. It's been pulled back a little bit because of the COVID crisis. There's a general theory out there that because household savings have risen and we've seen the supply of money rise, that should this COVID pandemic finally be put behind us, that there would be a flood of money back into some of the discretionary spending areas. Do you anticipate that to be the case, or is the savings that we've seen, is that money going somewhere else?
Yeah, I don't know if I would necessarily call it a flood, because there are challenges given the extent of the number of unemployed in this country. But you are right, savings rates are up. And there's a lot of pent-up demand. I mean, you speak to people, I think we all talk to people who are clamoring to get back to the type of activities that they were participating in, some of the discretionary spending that they were doing before the COVID outbreak. And so it should support the more discretionary parts of the market. I wouldn't get ahead of ourselves and call it a flood, because we are still dealing with significant unemployment levels in this country. But yes, for those who have come through this, saving rates are elevated, pent-up demand. The consumer should be supportive in this. And again, that's all in line with the recovery story that we expect to play out in the coming year.
What do you see as the biggest risk next year?
I think you mentioned it. I mean, you talk about inflation. I mean, my thesis on all of this is that policy is going to be accommodative for years to come. And in an environment where policy is accommodative, that means cycles can play out for far longer than most suspect. It also means that the dollar can be stable or weaker. We don't go back into that strong dollar environment, which happens when the Fed tapered their asset purchases or raised rates in 2015. So that would be the risk. If for some reason you start to see this money in the system circulate too fast and the productive capabilities of the U.S. economy don't keep pace with it, then you'll see some inflationary pressures. That would be unexpected. The Fed would have to raise interest rates, but that is not my base case scenario. That is a low probability event, in my opinion, but would be a high risk to risk assets.
Low probability, high risk. I hear that phrase more than you would know, Brian. Brian Levitt, Invesco Global Market Strategist. Thank you, as always, for your time. And more markets coverage coming up here on Bloomberg Markets to Close. We're going to talk about that pandemic-era savings. Is it here to stay? This is Bloomberg.
All right, welcome back to Bloomberg Markets to Close. We did get that close, a down day on Wall Street, pulling back from yesterday's record highs on the Dow, the NASDAQ, and the S&P. Pretty much flat on the day across the board. There really was no impetus here at all on the day. We did open higher on the day. We did see some of the large cap tech names get a bid, but then those gains started to reverse a little bit later in the day. Apple was at a record high. Snap was also at a record high. But again, some of those names did pull back. We did see healthcare names, interesting enough, not in the biotech space, Taylor, but mostly a lot of those, I guess, what do you call them? Medical devices? Hips?
Is that what we're calling them these
pumps?
days?
I don't know. You call them whatever you want.
I'm waiting for my fake hip to come in after all my running. Let's get back to the markets.
Go the distance.
We're going to do that with Bloomberg Markets reporter Kriti Gupta, because the best thing right after the closing bell, Kriti, is we can sort of take a breath and go cross-asset, and that's really what we want to do. We just came off this great interview with Brian Levitt over at Invesco, talking about risks, some of the key risks for next year. How do you take a look at some of the positioning that you're seeing in this second quarter and sort of the setup for next year? Because it seems like every asset class is at all the gains for this year.
Absolutely. Well, they're all looking ahead to that second quarter of 2021. It's this idea simply that we're going to see this inflation shock, the vaccine will be widely distributed. Essentially, everything will go back to normal starting that second quarter. And there's so much of that built up that it leaves markets extremely vulnerable to what happens in those first 3 months. And you've heard Dr. Fauci come out and say those 3 months could be extremely challenging. The Christmas virus fallout could happen in the middle of January. So a lot of the kind of investor focus right now will be on that economic data. Are we seeing that momentum that we need to get to that explosive growth we're expecting in that second quarter?
Does the market really care about this fiscal stimulus at this stage? I mean, it just seems that what was priced in earlier this summer off of the original CARES Act, that kind of had its course through the market. Now you have this new bill that's going to make its way into people's hands at some point, I guess, maybe this week or next week. Is it going to have that much of an impact on valuations?
Well, it's pretty interesting. You've actually seen a lot of that priced into markets. You're seeing that, these have been month-long negotiations, and every time we saw a stimulus headline that there was some progress being made, you saw buying right on that headline. So now you're going back into kind of this phase of how much of that stimulus is priced in and how much of more stimulus are we going to see in 2021. Both President-elect Biden and Senate Majority Leader Mitch McConnell have said, well, there's still work to do. We still have to talk about state and local aid, COVID liability protection, and of course, even more stimulus rounds. And that's why some of those Senate races in Georgia are so important going into 2021, because it really matters for investors. How easily can that additional stimulus be passed, or is it just going to be a month-over-month long negotiation once again?
You talk about that stimulus. I want to push forward to the segment we're doing next, and Romaine sort of brought this up, rightfully so.
Love it.
I give credit where credit's due. All about the savings rate, and there is some concern that we've all learned to save so much. All of our trips were canceled. Those of us who haven't seen an income drop due to the pandemic, do people keep saving, or do they get a flood of spending in the first quarter? And there is that quote sort of overheating that Larry Summers hinted at or sort of alluded to.
Well, absolutely. So there is still a lot of cash on the sidelines, whether you're talking about the people who are, everyday consumers, the average American, as you will, but also a lot of cash on the sidelines in terms of investing. And what that essentially does is, I'll start with the consumer piece of it first. When you see the savings rate this elevated, it kind of hinders that economic momentum story. At the end of the day, the U.S. economy is a consumer-driven economy. That means we need to see retail sales. We need to see that spending. And when you see these kind of stimulus checks, people would hide them kind of under their mattress, for lack of a better term, as opposed to go out and spend them. That's where you see that disconnect between what you're seeing in the markets, that cyclical recovery play, versus the fundamental underlying economy. And that's the major risk on the consumer side. On the investor side, of course, a lot of people missed out on this rally, the kind of quick acceleration that you saw based in tech after the March lows. So a big question is, there are a lot of people are looking for entry points, and the first quarter may provide that.
All right, great little wrap up here. Kriti Gupta, of course, covers markets for us here at Bloomberg. All right, let's get over now to the first word news. Karina Mitchell. Karina.
Okay, Romaine, thank you. President-elect Joe Biden says the coronavirus pandemic is going to get worse before it gets better. He spoke in Wilmington, Delaware, just earlier after getting a briefing from his COVID-19 advisory board. Biden criticized the Trump administration for the pace of distributing vaccines, saying it is, quote, falling far behind. He says he's aiming to have 100 million vaccines administered in his first 100 days in office, and he reiterated his call for Americans to wear masks. Meanwhile, more than 400,000 Americans will be dead from the coronavirus before President Trump leaves office. That grim prediction today from the Centers for Disease Control and Prevention. The U.S. has one of the highest mortality ratios of nations hit hardest by the virus, behind only Italy, Spain, and the U.K. scaled for population. The current U.S. death toll is more than 335,000. And Senate Republicans went against President Trump's wishes today. They blocked an attempt by Democrats to increase direct stimulus payments in the COVID-19 relief bill from $600 to $2,000 after Trump demanded the change. The motion passed the House Monday. Majority Leader Mitch McConnell says the Senate will address 3 of Trump's complaints this week, including the amount of the stimulus payments and concerns about election fraud. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
In economic terms, what we have to focus on is we have unnecessary human suffering and a lot of uncertainty for poorer people or unemployed people because of the disruption in getting the $600 checks out the door. But the stimulus package that is going to get approved or has been approved is really one that includes some of the key aspects you need, which is extending unemployment insurance, extending it to gig workers, backing the moratoriums on evictions, giving some aid to school systems. What's missing is state and local government aid, which McConnell also blocked previously. In terms of the dynamic you talked about, it's hard to imagine. It's just like the people who've been writing commentary. Maybe if Trump had passed stimulus earlier, he would have won the election. People do seem to value a check in their hand, so it's hard to understand why McConnell is opposing it.
Adam, I want to get to some of that aid to state and local governments, but first, I want to get to something that we spoke to about Larry Summers and the actual size of those checks that you were referring to. And he said Democrats capitalizing on the rift between Senate Republicans and the president might be good politics for them, but it isn't good economics, saying that this sort of arbitrary number of 2,000 is not as targeted as it should be. Do you agree?
I disagree with Larry on this particular point, because if the choice was getting out the $600 or getting out the $2,000, and that was the choice, then obviously get the $600 out because it's more important you get it out timely, and it's more important you get the whole package out. And probably Larry agrees with that. The idea that the 2,000 is going to be that big a difference versus 600, I mean, what you'll end up doing is a lot of people will put it in their savings accounts. So you won't get maximum stimulus, but a lot of people have a lot more than $600 need. So if it goes into their savings accounts, you tax it, you'll get it back later. I don't view this as a big deal versus making sure that the stimulus we've got passed. I wish it had been even faster. If you were designing this from the start, and this is where I agree with where I think Larry was going, if you designed this from the start, you would have wanted more emphasis on needs, on state and local government, on unemployed people, on evictions. You already have some of that, but have more of that, on loans to small business, not based on giving everybody a check.
There are baby boomers who are having to act as child care centers. There are parents who have been having to pay for tutors. Definitely that $2,000 can go a long way to the middle class as well as the lower middle class. And that should be something everyone agrees on. Let me ask you this in terms of where the United States, in terms of stimulus checks, compares to other European countries. For example, how has the United States stacked up against other countries in terms of providing stimulus check relief to its citizens?
The U.S. has put out there more than most European countries and most other rich democracies, Kevin, but the gap is smaller than the top line number, because in every other rich democracy, the welfare state's much more generous. You have health insurance, you have college paid for, you have various other provisions. So this is more what the U.S. calls discretionary spending every time Congress has to pass it. Even if you take that into account, though, the U.S. has spent more. Then there's a debate about whether it's done more good or not, because a lot of the European countries, France, Germany, some of the others, have tied their aid much more to keeping people in their current jobs and keeping current businesses afloat. In the U.S., as my colleague Jason Furman has written about, it's been more disengaged. It goes to unemployed people. It goes to people who may be leaving their jobs. And there's pluses and minuses to that. So, yeah, the U.S. has spent more, but it's partly catch up because we don't have a big enough safety net. And it's definitely we've spent differently. And only over the next year or two will we see what difference that makes.
All right. Adam Posen there, Peterson Institute for International Economics, president there, speaking exclusively with Taylor Riggs a little bit earlier in the day. We're going to continue this conversation because stimulus, of course, remains a sticking point in Washington. It remains the talk of the town there and pretty much everywhere else out there. There was hope for some sort of expansion of that bill that got passed to take that stimulus check from $600 to $2,000. A lot of questions here about the pace of the economic recovery. Let's bring in Jason Schenker. He's president of Prestige Economics, and he's chairman of the Futurist Institute. He's also the author of After the COVID Vaccine, in which he examines futurist scenarios of risk and opportunity post-pandemic. Jason, great to have you here. We're, of course, hoping we'll get to post-pandemic as soon as possible. Let's talk about the economic recovery, which is done okay. A lot of people still left behind. But in aggregate, it appears that the U.S. economy and a lot of the other major economies in the world right now are in recovery mode. Are you confident that the trajectory of that recovery is going to continue?
Well, I don't think it's necessarily going to be one way up from here. I think the next few months could be quite challenging. There's a chance we could blow it. For all intents and purposes, some folks think that on January 1st, we're going to enter 2020 and COVID is over. But it's not like that. And really, the next few months are going to be critical until we can get vaccinations to scale for those industries that have suffered the most to recover. That's going to be absolutely critical.
Jason, some have been making the argument that we're giving stimulus checks at the wrong time. By the time they get out there, the economy and some of that vaccine distribution that you talked about will start to be underway. And I know the risk of overheating right now sounds crazy, but it could be a threat next year if you have not only the stimulus checks, but everyone who's been saving all spending as well at one point. Do you see that as a risk at all?
Well, I think there's two pieces here. And the first is there are, according to the most recent jobless claims report, about 20.4 million people claiming some level of unemployment benefit. That's a huge number of people. Even if magically on January 1st, 2021, everyone were vaccinated and it all could be done at once and the 2 doses instantly, we would still have 20.4 million unemployed people. So that's a lot of folks. There's a lot of suffering there. There's a lot of income insecurity. There's risk to housing. There's all kinds of challenges around that. But as for the inflation piece, I think one of the biggest challenges will be what the data looks like. And when we roll into the second quarter, the year-on-year inflation rates could look quite high. We're expecting CPI in Q2 2021 to be 2.5%, core at 2.2%. But then it's likely to fall back down. We see the year average for both headline and core CPI is below 2%. But those numbers in the second quarter, because of the year-on-year base effect from the second quarter of this year, could happen at just the wrong time. As we're going into recovery, suddenly we see these big year-on-year inflation numbers, and it's more base effect, but that could wreak havoc in the financial market.
Jason, I want to get your thoughts on the much longer term view and about some of the changes that have occurred in U.S. policymaking because of the pandemic. I mean, the embrace for that first fiscal stimulus bill back earlier this year was pretty much unprecedented for Congress to, in a bipartisan way, to agree on that type of spending like that. Even the second bill almost seemed improbable, say, if you went back 2 or 3 years ago. Even what the Fed has done has sort of moved into areas of, I guess, unprecedented definitions. And I'm curious as to whether some of the shifts that we've seen by the Fed and whether we've seen by Congress and fiscal policymakers, whether these shifts are going to mark sort of a permanent change in the way policymakers view our economy and view the solutions to dealing with economic crises.
Well, I wish I could say this time was different, but a lot of what we've seen from the Fed was already in the cards, right? We knew a number of years ago. It was at Jackson Hole in 2016 where Janet Yellen said that the Fed in the future might want to look at buying a broader range of assets. We knew that was going to happen someday. And now we saw, in a response to COVID-19, massive balance sheet expansion. Is the Fed going to expand it again in the future? Very likely. Is it easy to reduce the balance sheet? Not at all. The Fed tried it 2018, 2019. The result was cut rates and the Fed re-expanding its balance sheet before COVID-19 happened. And of course, if we look at what happened when the European Central Bank tried to reduce its balance sheet size between 2012 and 2014, the result was negative interest rates, which they've now had for more than 6 years. So a lot of the Fed expansionary stuff going to happen every cycle going forward.
Jason Schenker of Prestige Economics, thank you as always for joining us, and Happy New Year. And happy days for me because I'm done with Bloomberg Markets at Close, but it's also happy days for Romaine because What Did You Miss is coming up next.
Oh, it's my favorite half hour of the day.
Joe Weisenthal is set to join.
It's a treat.
All about Bitcoin.
The stalwart.
This is Bloomberg.